Good morning and welcome to this Monday, April 17th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got a couple of things I want to go over this morning. We will be doing a special session today, how to create a winning ETF portfolio. I'm going to go through a few things first in the market like I usually do, and then I will show you what we do at Earnings Beats in creating our portfolios, which have now beaten the S&P 500 in 4 of the last 5 quarters. I guess ETFs are an investment vehicle that some use, others ignore. So it really depends on your own type of investing strategy. We tend to look a lot at stocks, but I know we do have a lot of members and a lot of investors out there who are much more interested in ETFs. And we have a really unique way of looking at ETFs and putting together an ETF portfolio, which I think is something you might find very interesting. So we'll get into that in just a little bit, but I do want to start off with just some of a look at the market, how we finished last week. Let's go. I'm going to say maybe close to half of the show we'll kind of do as normal, and then the second half I will get into the ETFs. So I'm going to start off taking a look at what happened on Friday to end last week. And it is option expiration week this week. I just want to point that out. Monthly options expire this Friday. That always gets us on our toes because a lot of times market makers have financial incentive to take prices a certain direction by the end of the week, or maybe into the week, or sometimes even into the early part of next week. We'll talk about that some more at our Max Payne webinar, which will be held tomorrow evening. On Tuesday, we always do it the Tuesday before the Friday that options expire. That is a members only event. If you're interested, go over to earningsbeats.com and make sure you sign up for our 30-day free trial, and then you can come in and take a look at what we do for our members leading into option expiration Friday. All right, but let's go ahead and take a look at what happened on Friday. Dow Jones Industrial Average finished down 143 points, S&P 500 down 8, NASDAQ down 42 on a percentage basis. All were within about 0.2 and 0.4% to the downside. Mid caps down 13 points, small caps down 9 points. That was just a little bit more selling pressure in those two areas. I am excited, though, to see that the mid caps and small caps AD lines are starting to turn back up again. Not quite as much on the small caps, but mid caps not too far off of the highs we saw back in February. So that was a good thing, or that is a good thing. Financials led the action on Friday. We had a lot of bank reports come out, big ones, JP Morgan, Wells Fargo, PNC, Citigroup. All of those came out, and especially JP Morgan, which was one of the better performing bank stocks heading into earnings. If you follow relative strength, JP Morgan's one of the bank leaders, and they produced a great report like you would expect a leader to report. And as a result, financials had a big day. They gained almost 1%. Energy up almost 0.2%. Discretionary a little bit more than 0.1%. Those were the only 3 groups that were up on Friday. So it was definitely a little bit more of a slant toward the value stocks, with financials and energy leading. To the downside, though, we had real estate and utilities. These were the only 2 down more than 1%, and they're defensive and value oriented as well. So it was really a kind of a strange day where the market didn't do a whole lot. We saw value leading, but we also saw value lagging, and we had a lot of aggressive areas right in the middle, not doing a whole lot on Friday. So overall, it was an okay end of the week after we saw some pretty good action. The S&P 500 closed, actually all of our major indices closed the week higher, which is good as we go into earnings season. But we'll see if they can continue to hold up, especially with options expiring this Friday. There could be some headwinds there in the very near term. We'll see what happens with that. All right, let's move on. 10-year Treasury yield. Currently, let's get an update there. We're at 3.57%, so we're up 4.5 basis points, getting back close to some previous highs that I would say are relatively key, right around the 3.65 area. You've got the 50-day moving average at 3.66. So once we broke above the 20, it kind of gave the yield, the 10-year treasury yield, a little bit of a leash to move higher. And I'd say right around the mid 360s could be the next target. Now, we do have a short-term top coming in just around 360. So let's call it 360 to 366. I think that's going to be a key area of resistance on the 10-year treasury yield in the near term. Moving on, S&P 500. You can see the key short-term resistance just up near 4,200. I'm still watching. For me, the big number is 4,300. That was the August high. If you look at from a long-term weekly perspective, lower lows, lower highs, that last lower high is 4,300. And we have gone down and put in a new lower low here. So that lower high right there is the important one from a trend standpoint. If you just looked up the definition of a trend, at least what I consider the definition of a trend, it's just a series of lower lows and lower highs, downtrend, and higher highs and higher lows is an uptrend. Well, we've got this downtrend in play, and the downtrend technically is ended if we go back up above and clear the 4,300, get through that August high. So that's the level that I think a lot of technicians are watching from a longer term perspective. Personally, for me, I think by the time you get up there, you've just missed half the move, if not more, of the post-bear market rebound. I've posted things before showing that the first 6 months to 12 months from a bear market bottom is when you have the most gains. So waiting for an 800-point advance before getting back in, to me, is wasting a lot of money. Potential money. So that's why personally, I like to follow a lot of beneath the surface signals. So I don't have to wait for that confirmation. I get a lot of signals telling me it's over. The bear market's over long before we break above 4,300. And I think it's over. But anyway, S&P 500, let's watch 4,200. That's kind of short term. And then 4,300 is more the intermediate term resistance that the S&P needs to clear. NASDAQ 100, similar, although we've already cleared February high. We're trending up above that rising 20, which is above the 50. A lot of the areas that lead the NASDAQ, like technology, consumer discretionary, communication services, those three sectors are crushing the other 8 sectors so far in 2023. And that's why we're seeing such leadership from the NASDAQ 100. We still need to get back through that August high, which is up near 13,750. So we've got, I don't know, maybe another 5 to 6% on the NASDAQ 100 until we get up to that level. But that's the one I would be watching. A breakout would be very, very bullish. I think would just confirm what I've been talking about for the last year. All right, chart of the day. If you are interested in receiving a chart of the day, actually it's 3 times a week, so it's not quite every day, but Monday, Wednesday, Friday. If you go over to earningsbeats.com, we have a free Earnings Beats Digest newsletter, and that's where we provide a chart 3 times a week. All it takes is your name, email address, hit that subscribe button. We'd love to have you. I focus on stocks based on earnings gaps, candlesticks, relative strength, and some of the other usual suspects, trend lines, moving averages, patterns, continuation patterns. Those are the types of things that I focus on in this EB Digest. Occasionally, it might be something to do with seasonality. It could be a short squeeze stock. There's a lot of things that go into it. But if you want to get a chart 3 times a week, learn more about the market, maybe even provide you a trading candidate if you so choose, that's completely up to you. I am not a registered investment advisor, so I don't recommend, I don't advise. We educate. That's what we do. We provide guidance, education, and a lot of research. So go to earningsbeats.com, scroll down, find this area, sign up for the EB Digest. We'd love to have you. We also do a lot of free events, by the way, throughout the year. A lot of free events. We just had a big one on Saturday, which was the bullseye forecast. And that was provided to anyone on our Earnings Beats Digest newsletter. So, I was given my forecast for the year. I think there's a lot of value, whether or not you agree with me or not, that's completely up to you. But those are the types of events that we do try to give back to the community. You need to be on the Earnings Beats Digest to take advantage of that. All right, so what was the chart of the day for today? Well, before I show you the chart of the day, I just want to show you a little lead up to the chart of the day. And that is the internet stocks, which had topped in February, put in a nice little cup right here off of this uptrend, went back into a handle and has just broken out. And look at it moving up, closing at a new high on Friday. Even though technology didn't have a great day, and even though communication services didn't have a great day on Friday, you can see internet showing some nice relative strength. Also, look at the AD line here, just soaring. A lot of hollow candles. I'm seeing so much accumulation in the internet area. So keep that in mind, number one. Number two, just talked about, posted an article. I've been telling members for a little while to keep an eye on this bottoming head and shoulder pattern on the XLC. But if we go back, let's do 2 years. I think it's a little easier to see it. So as we're coming down, you can see we topped back in September of 2021, all the way through the bear market. We really were rough until November. But before November, you can see we came down, we put in a low right here, which is a left shoulder. Went back up, put in an equal high, or put in a left side of a neckline. So bounced, that was our reaction high. Went down and put in one more final low. And then look at this bounce all the way back up here. Normally in a downtrend, you're putting in a series of lower lows and lower highs, right? Well, in this case, we come back up, we put an equal high. So it's already starting to tell you, that's the beauty of these bottoming head and shoulder patterns, is that it's already telling you it's somewhat breaking that series of lower lows and lower highs just by going back up to that previous high. So you got a beautiful left shoulder, left side of the neckline, head, right side of the neckline. I can, if you're having problems seeing this, let me annotate it for you. So right at about that 59 level coming across, left shoulder, left side of the neckline, head, right side of the neckline, equal highs. I like to either see them equal or sloping up. A lot of folks will do this. If we had bounced off of here and gone back, they would look at this and say, there's your downsloping neckline, and a breakout they would consider to be very bullish. Well, the problem I have with that theory is you still haven't broken the downtrend. You got lower low, lower high, lower low. When you come up here, you haven't taken out that high yet. So that's why I don't like downsloping necklines. I like to see at least equal coming across here, and which is what we have. Upsloping is even better. If you have a little slight break here above and then come back and go back up. But when you make this breakout, now you're not just clearing this high, but you're also clearing the one back here, which I think is really important. So if you see XLC over 60, it's happened. The breakout has been made. So keep those two in mind, internet and the group that internet belongs in, the sector, which is communication services, right? If that happens, we've got a great group within a breakout, a sector that's breaking out. Well, that's where the chart comes in. This is Pinterest. So this was the chart of the day for today. I'm looking at the AD line, which has been strong. I'm looking at the price chart, which has been pretty good considering that the end of last year, many internet stocks, technology stocks, and so forth really struggled in the fourth quarter. Notice Pinterest kept putting in higher lows, and I think that's continued. But if you look at these higher lows and the uptrend, and you look at what internet was doing, which was downtrending, then you understand why Pinterest is showing relative strength. It was moving up while its peers were moving down. Then it topped right here, and it's been going through this period of sideways consolidation. When we see consolidation, a lot of times we also see relative weakness. So here you can see the relative weakness coming in for the last 2 or 3 months. I believe, though, if we get a breakout in Pinterest, that will end the consolidation period. And I believe you're going to see this stock move back up again. So this is a stock I have my eyes on. A breakout here means that it's a pretty strong stock in a very strong industry group within a sector that has been leading in 2023, making a big breakout, or at least on the verge. So this is what I look for when I look for individual stocks. I try to find stocks that have shown some relative strength, that are either in an improving industry group or a leading industry group, and also within a strong sector. If you get all that lined up, your odds of trading success go up considerably. All right. Before we go into the ETF analysis, which I want to get into, I do want to just mention that there are some more financial related earnings out this morning. One is Charles Schwab. And I just told you how important it is to have relative strength. Well, let's pull this one up on a relative basis. And so here are your investment services stocks going down. And look at Schwab relative to investment services. The last 90 days have been absolutely horrible. Hold on one second. All right, thank you. So Schwab has been underperforming the investment services area now for 90 days. That's not a good look heading into your earnings report. So it's been losing ground to investment services, and look at it relative to the S&P. 3 months ago, it was on top of the world, completely fallen apart. Now they came out with their earnings and they did beat slightly, 93 cents versus 90. But last time I looked, they were down a little bit in pre-market, down a little less than 1%. I mean, maybe we see a little bounce, maybe a relief rally, but I don't like what I'm seeing on this chart on Schwab. And this is the type of stock that I would be completely ignoring as it heads toward earnings. If I'm even thinking about holding a stock into earnings, which you have to understand, it doesn't matter what stock you hold, you are taking a big risk if you're holding it through its earnings reports. Some of you might be buying holders where you just buy a stock and hold it long period, long term. Okay, I get it that you maybe not concerned about each individual quarter earnings. But if you're a trader, you're interested in protecting your capital. Capital is your biggest, that's your asset, that's your business. And so going into these earnings reports, yeah, you might get a 10 or 20% pop, but you might lose 10 or 20%. And we always kind of focus on, well, I don't want to miss that 10 or 20% pop. We don't think as much about how much we could lose. Some of these stocks we're going to find are going to have some pretty rough reactions to their earnings coming up this quarter. And I would be careful with some of these banks. JP Morgan was a leader, had a beautiful day on Friday. Some of these other financials not showing that kind of leadership. They're kind of weak among a weak group. And so sometimes you're going to get not only what could be bad reports, but maybe warnings. Future guidance could be lowered. Those things tend to drive prices lower. So you want to be a little careful. I just want to mention Schwab reported. How about State Street? Let me come over here and show you State Street, which is STT. They missed on their earnings. 152 on earnings versus 162. And stock down 10% after or the market reaction this morning that I saw. One other one, MTNB or M&T Bank beat 409 versus 398, and they were getting a slightly positive. I think they were up about 1.5% in pre-market. Now, those pre-market that I gave you, that was before the show, so I don't know if they're still sitting at those levels or not, but that's what I had seen. Anyway, just wanted to pass that on. All right, so we are going to move on into the second half and a special presentation, how to create a winning ETF portfolio. And what I want to do is I'm going to show you the ETF analyzer, which is what we use when we're going through and putting together a portfolio. You might put your portfolio together kind of randomly, haphazardly. You might hear about a great ETF over the water cooler at work, and you decide, oh, I'm going to put some money in that one. I will just say this to start off. The one thing I always say, if you're going to be into ETFs, is know what you own. If you own Apple, most everybody knows what Apple does, right? But you can get into some ETFs and you might think based on their name that you know what they have, but you probably don't unless you know the individual stocks. Now, the way I approach putting together a portfolio of ETFs, number one, first thing I start off with is the S&P 500. I go through and I find out, and I get my information from Fidelity, but I go through and I find out the representation of each sector within the S&P 500. So technology, this was last quarter. This is the ETF analyzer that we did last quarter. Technology was almost 26% of the S&P 500. The discretionary group was almost 10%. Communication services, 7%, so forth and so on all the way across, as you can see. Now, the first thing I do is I start putting together a game plan. Like, I don't know, maybe a football analogy. If you're a coach and you're going in and you were thinking about, your opponent that you're going to play, you might take a look at their tendencies. Okay, they're not very good against the run. They have horrible third down defense, trying to defend the pass, whatever. And so you're using their weaknesses and your strength, and you're trying to formulate a game plan that if we get in these situations, these are some of the plays we want to run. This is what we want to do. We're anticipating. We're trying to be aware of who we're playing and what's going on and the different situation, have situational awareness, all of these different things. So what I do is I go in and I'm looking and I'm thinking, okay, first of all, do I think the stock market's going up or down? Because answering that question should start to point you in the direction of where you want to be in terms of putting together a portfolio. If I believe the market's going up, which I do, and I think that we are resuming the secular bull market, and which started back in 2013, which I do, then I'm going to want to favor the groups that do well in those types of advances. And so technology, consumer discretionary, communication services, these are three groups that tend to do well when the market is in risk on mode. Industrials, financials to a lesser degree. They're a little bit more value oriented. So sometimes you'll see rotation among these five. When technology and discretionary and communication services are going down on a relative basis to the S&P 500, if that money is rotating over into these two groups, I'm not feeling so bad. But if it's coming out of here and going into the defensive groups, then I'm feeling a little bit worse. And especially if the market's like trying to make a new high or is going up, it's been going up for a few weeks, and defensive groups are leading, then I might be a little bit more cautious when I put together my portfolio. But this year, these three groups are crushing the rest of the market. And we're about to go into a period where growth tends to get most of its strength versus value. If you look at the entire year over the last 10 years since the secular bull market began, and you look at growth versus value, you'll see that growth, depending on what ETFs you're looking at, like I like to look at the IWF versus the IWD, or even the QQQ versus the SPY. Both of those have outperformed, the QQQ has outperformed the SPDR, and the IWF has outperformed the IWD by roughly 4 or 5% per year since 2013. And if you did a little bit more research, you would find that the majority of this relative strength comes in the months from May to August. Check the calendar. It's April 17th today. We're coming up on that May to August period. Now, does that guarantee us that growth's going to outperform value? No. Growth doesn't outperform value every year. Please don't misinterpret what I'm saying. What I'm saying is that history tells us that there is a tendency, a fairly strong tendency, for growth to outperform, not a guarantee. So it's all about managing risk. Do you want to be more defensive going into the next 3 months, knowing that history argues against that? I mean, some of you may say, hey, I just want to be safe. I don't want to take any chances. And that's fine. That decision is a personal one, which is why we don't recommend or give advice, because we have a wide range of members across the globe, ranging in age, ranging in income level. We couldn't possibly give a one-size-fits-all blanket endorsement of certain stocks or ETFs. So what we do is we say, hey, we tend to be a little bit more aggressive at earnings beats. Why? Because aggression usually leads defense over time. 7.5 out of 10 years, stock market goes up, you're probably going to be better off in growth. But there will be years when you don't. If you're older, I get it. Hey, you don't want to take any chances. You make a big mistake. You're in your 70s or 80s, you make a big mistake with your portfolio. It's not like you have a lot of time to make that up over the next 10, 20, 30 years. I completely get it. So everybody has to make their own personal choice. But what I would be looking at is upping. I would want to get higher percentages in these, in my portfolio. I would want maybe 30 or 35% representation in technology, maybe 10, 12% consumer discretionary, or maybe even 9%. Consumer discretionary is still struggling a little bit. Communication services, I showed you, this group is leading the market in 2023 and on the verge of making a very significant breakout. And you might say, well, yeah, but it's run so much. Look at how far it dropped over 15 months, 14 months. September 2021 to November 2022, this group was crushed to the downside. So it had 3 good months and that's it. If I'm right about the bull market resuming, there's a lot more to the upside. So that's the way I would do it. I would be skewing it a little bit more. So how do you go about doing this? Well, what we do at Earnings Beats is we go through and we run a scan for strength in ETFs. And in that scan, we ignore leveraged and inverse ETFs. We ignore international ETFs. I'm not going to try to be an expert on domestic stocks and ETFs in the US and also try to be an expert all around the globe. I mean, I'm going to get spread too thin. Find someone else or go and find a favorite ETF for your international exposure if that's what you want. Same goes for bonds. Find your exposure elsewhere for bonds or currencies. I'm not getting into those things. I'm looking at US equities for the most part. Now, I want scooters to be at least 70%. I want PPOs to be above 0, maybe even above greater than 1, because that shows me momentum. I want relative strength. I want some momentum. And then I run the scan and I pull all the ETFs that meet my criteria and they get listed on the spreadsheet. Ticker, name, top 10 percentage, which I'll show you in a minute. Then all the percentages of the various sectors. The top 10 right there, 23%, that just goes, it tells you how diversified the ETF is. The top 10 holdings, if they make up 67%, like this energy ETF does down here, then they're very concentrated in a few names, 10 to be exact. But if you look at this small cap index, the top 10 holdings are only 3%. It's widely diversified. So sometimes I've put together these portfolios. There'll be like 6 or 7 ETFs. Usually it's between 6 and 10. But sometimes I'll do 6 and 7. I've had members say, well, you only have 6. That's not enough. You're not diversified. Well, it depends which ETFs you own. If I got this one in here, one of my ETFs probably has a couple hundred stocks in it. You know, so if you're putting together 6 or 7 ETFs and 2 or 3 of them are very diversified, you've got a huge, huge group of stocks. You're very diversified. So don't base your diversification on how many ETFs you have. Base it on which ETFs you have. And whether they're diversified. This is just telling you that which stocks are, what if they were all in one sector? So all of a sudden you'd see 100% over here in industrials. So yeah, maybe it's spread out among a lot of industrials, but they're all industrials. So you want to look at the percentage, you want to look at the spread in trying to put together a portfolio that makes sense. Now, we've done this now for 10 quarters. 10 quarters, every 3 months, we put together these portfolios, and we're about to beat the S&P 500 for the 6th month out of 10. 4 of the last 5. And this is how we do it. We try to anticipate where we believe the strength's going to be, and then we try to figure out what kind of weighting we want in each sector. And then we go down and we pick the ETFs that make the most sense to meet our objectives or our goals. So last, I'll show you the first, the top 10 holdings. So here was that AVLV. If you look at this right here, AVLV, top 10 holdings, 23.12%. You go to the top 10 holdings tab, and here's AVLV. There's your 23.12%. And here are the 10 stocks included in there. You see some pretty big names. You got Chevron, you got Johnson & Johnson, Merck, Pfizer, JP Morgan, Apple. I mean, these are really good big names. This might be a portfolio that you love. But again, this is how you know what you own. If somebody just says, hey, I like AVLV, and you go buy it, you don't know what you have. If you're putting together 6 ETFs, are you diversified? Are you meeting the objectives of what you really want in that portfolio? This, if I have 2 ETFs and they're both similar, a lot of times I'll go back and look at their top 10 holdings, and I'll make my decision based on which stocks they own and whether or not I like those individual stocks. Over here, now the percentages are pretty similar, but looking at cows versus AVLV, maybe Pfizer's a great stock. Maybe I really like Pfizer, and the fact that Pfizer's number 1 on their list and it's down a little bit over on this list, maybe that's why I would make a decision. Or maybe I really like Moderna, and wow, this fund has got some Moderna in it. That might be something that, I focus on. But after you decide which stocks you want, the beauty here was what we did last quarter. What we do is we go in here and we put in an allocation percentage for each. And you could do this as an Earnings Beats member. You can download this Excel spreadsheet into your own account. And so you could go in and decide that, hey, I want to put in, I don't like the way Tom put it together. I want to do my own. And so you can go in and put percentages in each one. And after you do this, what it does, like for cows, 20%, it takes 20% of 11.37 and puts it over here. 20% of that is 2.27 in technology. 20% of 5.61 is going to be a little over 1%. That's how much is going into discretionary in your account if you were to put in 20% into this one ETF. So after you get done, all these are spread out over here. And then you get down here to the bottom. Well, actually, what it'll do, it'll add up everything in the column for technology, and it'll put it right here in your results. Now, what if you go down here and you put in all these different percentages and they don't total 100%? Right now, mine equals 100%, so it's saying no error. But what if I said, made a mistake and said, I'm just going to put 10% in there? And you think you've got 100%. Well, it's telling you there's an error. You only have 90% invested. So you got to get another 10%. So then you put your 20 back in. But notice what I did here above the S&P 500. This is what the actual representation was when we selected our ETFs 3 months ago. So technology was 26%. We wanted to put in, I just ballparked it and said, it'd be nice to have 32% in technology. Discretionary was 10%. I said, I want to get 16% discretionary. And communication services, 7.25%. I said, I want to get 10%. Industrials and financials, I underweighted. Healthcare, I left about the same. Staples, I underweighted. Real estate, about the same. Utilities, underweighted. And then energy and materials. Materials, I left up a little bit. Wanted to be up a little bit higher in both of these. Just a little bit more of a hedge. But anyway, once I did that, then I can put my percentages in here to the different ETFs that I want, and it'll automatically calculate my results up here. So I can look at it and just see, okay, am I comfortable with this? And yeah, I mean, I was pretty close to what I had wanted. Maybe a couple were a little light. Healthcare was a little light. Consumer discretionary, a little bit more than what I wanted. Energy, a little bit more than what I wanted. But at the end of the day, I was comfortable. But again, I knew exactly what we owned. And we're now up. I don't know. I think we're up a little over 50 basis points this quarter. So the S&P through Friday was up 6.12%. We're up 6.64%. And you might not think that's much, but we're up 0.5% this quarter. Last quarter, we were up 80 basis points. Quarter before that, we lost by 1.3%, 130 basis points. Quarter before that, we won by 4 full percentage points. And the quarter before that, same thing. Basically 4 percentage points. So we've been doing a pretty good job of this. And we're going to have our next event on Wednesday. Wednesday evening, we're going to have our model ETF portfolio draft for our members. So if you want to become a member, you'll get our event tomorrow night, Max Payne. You'll get our event on Wednesday night where I'll unleash and unveil all of the ETFs that we're putting into our model ETF portfolio for the next 3 months. You'll see exactly, I'm going to go over the different themes, things that I was thinking about, why I want to put more in this area versus this area. You can disagree with me, or you can just say, hey, I want to be more conservative. Or maybe some of you might say, I want to be more aggressive. If you think the market's going up, maybe I want to put twice as much in technology. That's everybody's call. But we'll go over more of this in detail on Wednesday when we do the draft, or any quarter when we do the draft. This is what we do. We go over the spreadsheet. We go over the themes. We show you where the money's going. We talk about what we were looking for to try to get our percentages to or up to in each of these various sectors. And then how did we do? Did we meet our goals with the ETFs that we picked? So should be a great evening. But if you like this, if you like the show, make sure you like our video below. That really helps us. Also subscribe. That'll really help us at Earnings Beat. So even if you're not a member, I would strongly suggest you become at least a EB Digest member. That's free. We provide a lot of good information there. You can come to all of our free events. But definitely make sure you like the video and subscribe to our channel here. We are getting a lot more positive response from these YouTube streams that we've been doing, these live streams. Leave us a comment if you like what we do or you like the ETF. We'd love to hear from you. If I don't hear anything and I'm just hearing crickets, I don't know, maybe you had the mute on, or maybe you were sleeping. So I'd love to have some comments. But anyway, that's it for me. And I hope you enjoyed this. Happy trading. And hopefully see you at the events coming up later this week. Bye.